I want to start by saying congratulations. I know you just ran another marathon, the New York City Marathon. I think that's your 10th New York City Marathon and your 26th overall. I actually brought in the medal from the 2009 New York City Marathon that I ran. We were comparing the medals from back then and the one you got this weekend. Yours is a lot nicer, but
there's been medal inflation.
Medal inflation. It was much brighter and nicer and bigger. You devote a lot of time to running and you devote a lot of time to market. So what's the connection between the two?
So first of all, it's wonderful to be back. And I do like talking about markets and marathon running. So this is probably my favorite question at the bit. So I'll say a couple of things. The first is I run marathons because I have no skill and it does not need skill. All it needs is just putting one foot in front of the other, being disciplined about it, and giving a little bit of yourself every single day. And I think that's the exact same thing if you're an investor in the long term. You don't have to have a tremendous amount of skill, but you do need to dollar cost average in. You do need to spend a little bit of time every day thinking about investments and thinking about markets. So that's one similarity, I'd say. And then the other one, I say this about running, but also about careers in general. In the marathon, Oscar, I'm sure you remember this from when you ran it, you run your own race. And you don't think about who is around you, how fast they're running. You just run your own race based on your own time goal and your own training regimen. And I think it's the same with markets. Think about your own outcomes that you're looking for based on your own age or your profile or how much risk you're willing to take. And don't worry about other people's investment habits or where flows are going. Be aware, but think about your own sort of risk parameters. So that's another one. And then the last one I'd say is, I'm in my 40s now, and I've run, as you mentioned, 26 marathons, and the body is so different now than when I first started running in my 20s in terms of how much more I have to do, cross-training, creatine and magnesium and yoga and all of that to just have similar outcomes. And I think it's the same in markets where portfolios change, volatility change. You constantly have to think about diversification, and the diversification instruments change as well.
I love when we can draw parallels between the markets and then something that you do in day-to-day life. And you've done that really well. And what you mentioned about running your own race, it's sort of like you want to get to the finish line, but people are going to get to that finish line differently. And maybe when we talk about retirement, that feels sort of like a finish line or something later in life. And again, people take different paths to get there. Let's talk about markets, though, more specifically now. And let's start with monetary policy. There's been a lot of, maybe some people would say, confusion around the Fed this year and the path on rates. Will they cut rates? By how much? When? And we've seen recently that they've cut rates by 25 basis points. We've seen a similar story elsewhere. For example, the Bank of Canada cutting rates. How are you thinking about the rate markets, the rate cut story, and what's next in terms of monetary policy?
Sure. So this is obviously something that clients are asking a lot about. There are two things that I think are leading to some of these questions. The first is that there is an acceleration, if you will, in the level of growth in the U.S. economy, especially when we think back to the last time we spoke at the BID, which was right around Liberation Day, where many were thinking about slowing down in growth, perhaps even a recession. And we're recognizing today that Q2 GDP, as well as expectations of Q3 GDP, if we look at some of the estimates from the Atlanta Fed, for example, they're at the high threes. And at the same time, inflation is coming down pretty significantly, which is very good, as well as job markets are moderating. So all of that is allowing the Fed to cut at a time when growth is pretty solid. Now, what I would say to that is that, depending on who you are in the economy, depending on your income level, you might be experiencing quite a different U.S. economy. So rates coming down is actually a good thing for a whole swath of the economy. And we do expect the Fed to continue on the rate cutting cycle. So they've brought rates down to 3.875%. We actually think that they'll cut again, more likely than not, in December. And then they'll cut a little bit more next year as well to bring rates down to that 3%, maybe a little bit below that 3% level. I think a little bit of volatility was injected because Chair Powell did say that another rate cut in December is not a foregone conclusion. And he said that because obviously there are some pockets of strength as well to contend with, and inflation is still not at target. But I do think we have to keep in mind that as long as inflation is making progress towards their objective of about 2%, as well as long as we see that labor markets are softening, the Fed does want to be forward-looking. So rate cuts, we think, still to come, and then getting rates down to that 3% or so level.